joining this morning, and I think we'll get things underway on time today. We've got a few things to cover in this quarterly review because many things have changed in the last 3 months, and a lot of them have had some significant impacts on residential property markets around Australia. So let's get into some of the latest information and our take on how some of those things are going to potentially impact the course of, say, housing prices over the next year, 2 years, longer. What's going to be an important driver in terms of what happens to the path of interest rates, and we'll go through some of the questions that we're getting asked all the time by our clients around Australia and our expat clients around the world. So a bit of a disclaimer there, as always, very important. Please read that because this is general information. It's not intended to be specific advice, financial advice of any sort. So if you do need any help with your own particular situation, please don't hesitate to reach out, call us or email us, and we'll have somebody assist you if we can. Just a little bit of background for the people that don't know us. We have been around for a long time, and the structure, I suppose, of various businesses within the group are important to recognise, because if you're an Australian resident client, your needs may be different to the needs that we have with expat Australians around the world. So if you look at that, Wise Guru is the international consultancy business that was founded to help Australian expats around the world with a lot of, help in relation to them buying Australian property, because look, it's an anxiety producing, difficult situation at the best of times, even if you live inside Australia. But if you're thousands of kilometres offshore somewhere, it's really important to be able to look at someone and get some assistance with all of this. So that's how we've actually structured that to help people and to facilitate that process and refer them to our panel of experts in various legal, accounting and tax areas that will assist them with that whole transaction process. And then also from longer term, it's like a bit of a hand-holding situation. But here in Australia, Unicorp Partners is the licensed financial advisory practice that assists clients with all of their financial advisory needs. So superannuation, investments, listed investments, risk management, etc. We have Aussie Loan Guru, which specialises, as the name suggests, in the provision of funding, of mortgages for people to purchase properties with. And Aussie Loan Guru is the Australian registered real estate business that helps people with their real estate needs. So moving on, I guess these are the things we look at, the most relevant questions and the most common questions we get asked most of the time. And while some of those have stayed the same, lots of other ones change a little bit. And it also depends on, I guess, people's demographics. So we find the demographic of people that we deal with remains pretty constant. Doesn't matter if you're a neurosurgeon in Sydney or a banker in Hong Kong. Our clients tend to have high incomes, they're high income earners. They want to make better informed choices, but they're very time poor. So they can't actually do a lot of the research themselves because they simply don't have time. And they'd like to invest in property. It's something that we find that most people around the world like to do. Most of them would obviously like to invest in Australian property, because whether you live in Australia or you're an Australian expat, at some point in time they probably will return, and they want to build their asset base, that wealth, in an affordable and, very importantly, in a tax efficient manner. So we've developed our own concierge service which assists people with all of that process. We charge $4,950 Singapore for that, but it assists people with not just trying to help them locate properties that might be relevant for their particular set of circumstances, but we help them with the whole process of then obtaining financing, all the way through to settlement, assisting people with pointing them in the right direction to get property management assistance to find tenants, and ongoing, as I say, hand-holding to help them with tax and other matters that pop up from time to time thereafter. So what are people asking us? At the moment, most relevant things seem to be how much will the RBA continue to cut interest rates by, when's it going to happen, and will the banks pass that on in full to us as retail borrowers? And I'm sure many people are thinking that themselves that may watch this video. So that's really important, but it sort of relates to some of these other questions. So look, now people are saying how much a property price is going to increase over the next year or two, when it was only 6 to 9 months ago when people were concerned about potentially how much a property price is going to decline. So that's been a really big turnaround, a different question. The next one's been there for many quarters, and people are still looking for advice or guidance on areas that may be better suited from an investment viewpoint, because the key drivers of population growth and the type of population growth are really important to the outcomes of housing prices over the medium and long term. Another question is around rents. Rents have increased quite a lot. We've had a couple of quarters of stability in rental prices. People are saying, are they going to continue to increase? And recently again, because in Australia we've had the economic roundtable that the Treasurer has called, a lot of questions about whether the government's going to change negative gearing or capital gains tax discounts. They come out virtually every year, usually around budget time. But we'll go through those and try and create some meaningful answers for our clients on that. So look, as you all know, research is really important, but in Australia it's massively important because it's a massive country. It's a continent, and things are happening in different parts of that continent in a different way from an economic viewpoint. And we tend to use data that's available from the Australian Bureau of Statistics, some of the national research providers, Cotality, which was called CoreLogic, Resolution Research, Oxford Economics, MB.BS, and data from the Australian Population Centre, etc. Because you tie all that together, but you've got to really then try and use, I guess, experience to make sense of that. Otherwise, it's just statistics. So, here's a big one. People are talking about and asking, what about interest rates? How and when will they come down? We've seen now, as we've peaked through the cycle of 4.35% being the official cash rate set by the RBA, we've just had the August rate cut, which has brought that down to 3.6%. I still think that's restrictive in terms of monetary policy, and I think the RBA is coming around to that sort of opinion also, because inflation has come down and it's in the mid-range band that the RBA considers between 2 and 3%. So I think we're going to get another rate cut probably in November this year, and probably 2 more thereafter. So the official cash rate could well come down to say 2.85%. The RBA is keeping an eye on, as you can see here, all of the, I guess, important issues that will impact monetary policy, but probably the most important one now is what happens to the unemployment rate. And they've sort of painted themselves into a bit of a corner there, because they're saying that's really what's going to impact how they make decisions, because most of the other factors are trending the way they would like to see them, and potentially causing some slowdown. So the big problem is, they want to make sure, and we want to make sure that people don't start losing their jobs in an accelerated basis because monetary policy remains too tight, too restrictive. The impacts obviously that's going to have on housing markets is fairly clear, and we've seen that from the first cut that we had in February this year. it has put upward pressure on housing prices virtually everywhere, even even in Melbourne, which was languishing. So I think that'll continue. So if we have a look at some of these underlying issues there, look at the annual change in inflation. As you can see, the headline inflation is down to 2.1%, and core inflation at 2.7%. So, and you can see the trend. I mean, it's fairly evident and fairly obvious to anyone looking at that is going to help the RBA with their further rate reducing decision making process, if you like. As long as that data continues like this, that's what will happen. But if you have a look at the unemployment rate here, it's ticked up to 4.3%, which is still at multi-decade lows. However, it's trending up, and the RBA basically said in their statement of monetary policy in the last meeting that they believe it will remain there over the next 12 to 18 months plus. So that's what you've got to watch, because if unemployment does start ticking up, then that's why I say they've sort of painted themselves into a bit of a corner, and they would have to, I think, then look at perhaps making interest rate reductions either greater or doing them more quickly. So if we have a look at the change in house prices in the 2 years after the start of a rate cut cycle, if you look at this graph on the right, this is what's happened over time. And as you can see, the only two times where those increases were below 10% was in 1984 and 1992. And at those times, the unemployment rate was above 10%, and that's where we saw the smallest increase in house values. Whereas now, as I said, it's at multi-decade lows. So I think people need to be aware of these important tailwinds that are going to impact markets, and they're here to stay. So if we look at housing credit, it's interesting to see that interest rates obviously are coming down for all borrowers, so that's homeowners and investment loans. And variable rates are coming down. We're still getting a few questions from people about, should I fix? Well, at the moment, I'd say, that's not really a question. It's quite clear. I don't think you would fix, because rates are going to continue to come down. We don't know when and by how much. So we certainly would be telling our clients that a variable interest rate currently is probably the most conservative choice to take. As you can see, their short-term fixed rates have tracked lower, but there's been a little bit of perhaps more aggressive cutting in fixed rates from some of the major banks, and that's probably being done just for the reason that I've expounded. So stay variable. Here are some of the forecasts from Westpac, and as you can see, they expect a rate cut in Q4. Bringing the rate down to 3.35. I agree with that. I think it's probably going to be November. But then another couple of cuts early to mid next year. And the timing of those cuts, as I say, I think will be very dependent on the employment data. So they may actually be accelerated. That's going to be important. It's going to, as we're seeing now, increase, I think, some of that upward pressure on housing prices, and that's due to people's affordability increasing due to borrowing capacity. So that means the banks are going to lend people more. They're going to be able to lend people more because the serviceability factors have decreased, and that'll generally mean that people can pay more. So that's one of the most important things. And the other one, I guess, for a lot of our Australian expat clients, of course, is the exchange rate. And if we look at Aussie, US, that's forecast to increase modestly over the next 2 years. And I think at the moment a lot of our expat clients, especially if they're being paid in US dollars, but also sterling, Hong Kong dollars, etc., are saying, well, look, it's a pretty good time for me to move some funds into Australia, take my US dollars or whatever the currency I'm getting paid in, and taking that back to Australia, because it gives them a bit of a discount, if you like, in terms of just simply currency fluctuation.
So if we have a look at what's happening, the value of investor lending is up nearly 7% over the last year. So that's been a bit of a change, and it just shows you what's happening, I suppose, with sentiment, with the market. So more people are now entering the market, entering the residential property market from an investment viewpoint. And I think as those interest rates feed through and more come through, that'll continue. So it'll be interesting to look at this data over the next 2 quarters and see what happens, but I think that'll increase further. If we look at one of those questions initially, which areas are likely to benefit most from population growth, and then we look at both. So overseas migration and also interstate migration. I mean, natural births and deaths are going to remain pretty well the same, but those 2 factors can change. And they're very different for different areas around the country. So we all know that we had a massive bump in net overseas migration post-COVID when Australia opened its borders internationally in 22. And as you can see there, that's that large peak around December 23. It's been declining since then, but I think what people need to be aware of and need to remember is that Australia's population at the end of December was nearly 27.5 million people, and the gross increase, I suppose, is one of the largest in the developed world. So whilst this has peaked, it's still one of the highest numbers for decades, and I don't see that changing a great deal either. So what does that then do? Here, this is a graph produced by the ABS, Australian government, in terms of what their projections are. And I think as we're playing this out in current times, some of these numbers have changed a bit, but ultimately the rate of immigration into Australia is high and it's going to remain high, in my opinion. So the other part to look at there is, the quality, I suppose, of housing credit, and people talk about this all the time. I've been talking about this for a long time, and I think the quality of housing credit in Australia is incredibly good. We only have to look at what happened in the US when the banks were lending money to people that didn't even have an income. So if we look at what's happening in Australia, the quality of loans is generally around debt to income ratios, percentage of loans with a loan to income ratio greater than 6, loans originated with high LVRs or loan to value ratios, and percentage of interest only loans. Now, all of those things, as you can see there, would indicate that the Australian banking system is in really good shape. The fact here that interest-only loans have increased somewhat over recent times is really a byproduct of higher interest rates. And anyone will know who has a mortgage in Australia that if you're paying principal and interest repayments, they're much higher than interest-only repayments. And with current cost of living constraints, many people are saying, well, look, I would like to have an interest-only period for whatever, 5 years, let's say, so that I can accommodate those into my cash flow. And in terms of LVRs, there's been a bit of an uptick lately, but again, nothing I think that anyone needs to concern themselves with. So, if we look at property as an asset class, it tends to do that over time. It tends to increase, and I don't think that's going to change. So let's have a look at some of the facts and ramifications. Residential property now is $11.6 trillion in Australia. Our retirement system, superannuation, is one of the top 3 in the world, and that's at $4.1 trillion. So you can see that residential properties are really the most important asset class in the nation, and as such gets a lot of attention, and obviously is also really important from the banking system's viewpoint. So if we look at Australian housing values for this quarter, they're up in aggregate 1.8%,
3.7% for the last year. And the value gap now between freestanding homes and apartments is at an all-time high. It's 48%. And this is in capital city markets because clearly they're the more mature in that area. But that's a massive premium. So that's now starting to play out in terms of choices that people are making, because in many instances people actually are looking for amenity, and thereby they usually want to be closer to either a CBD or a town centre where you have far greater access to amenities and healthcare and employment, etc. So I'll go through that a bit more detail, but that's something that is happening. So if we look at the 3 monthly change or the quarterly change, it's been positive in all areas, but it's varied quite a lot. If you have a look at these, charts, Darwin and Northern Territory have been standouts in terms of dwelling price growth and rental growth, etc. But they've come off a low base, and it's a very small population in terms of a capital city market. So if you look at the established ones and say the East Coast markets in the main, Sydney, Melbourne, Brisbane, you can see there's quite a lot of variance in any of these, and that's also being seen, I suppose, between capital city markets and regional markets. But regional markets are more volatile, as one would expect. The depth of employment growth and population growth there can be less. So all of those things are something to bear in mind, but I think the overall fact to draw from this is that these are all positive, and I think going to remain positive and continue to grow over the next 12 months. So if we look at it with a bit more granularity, in the last 3 months to July, all the value segments in the major capital cities have shown positive outcomes. And if you have a look at that, Sydney, Melbourne, whether it's the upper quartile, lower quartile, or middle, they've increased everywhere. Adelaide in the upper quartile, perhaps a little less. Hobart's the only capital city that's had a negative outcome there, and that's been in the upper quartile. So very strong overall. As you can see, Darwin super strong, but as I say, coming off a lower base. So we'll go through some of those numbers in further detail, and we're seeing strength in every quartile in the major capital city markets. This is the most important thing, and there's been so much talk about this in the media. Australia's chronic housing shortage. We need to fix so much unnecessary red tape that's existent in regulations, building codes and building regulations around the country, and that's putting a lot of pressure, obviously, on a nation that has already suffered from an undersupply of housing for a very long time. So the government's goal of 1.2 million new homes by 2029, I think, is really just a pipe dream, unless they get their act together and speed up a simplification of the process. I don't see that happening. If we can look at really, we've been undersupplied for a very long time, and it's just too hard to catch up. And one of the reasons for that, of course, is immigration as well. So, we'll come to that in a second, but people often, ask us the question, what should I be investing in, equities or property? And really the answer is they're both growth assets, and I think it's important to own both if you can, clearly. We tend to, it's a generalisation, look at perhaps pointing the equities investments more through superannuation, where you're not going to use gearing because they are mark-to-market assets, and obviously values can fluctuate very quickly and by a large amount. So quite often, if you're employing gearing, i.e. borrowing against that asset, your equity could be exposed and wiped out without you having the ability to safeguard it. Whereas on the property side, you can borrow your 80% or if you're a client of ours, 85% for most housing. And if the value of that dropped tomorrow by 20 or 30%, the bank is not going to call you and ask you to top up the equity so that they don't have to make a margin call, because there are no margin calls on that style of residential property lending. So really important. I guess that's where you can use other people's money efficiently and conservatively to increase your ability to increase the value of your asset base. So if we have a look at other things around the property market that we get asked a lot about, as I said initially, are rents going to increase? Well, higher rates for longer means higher rents for longer, and we've had 3 rate cuts now, so people would think, oh, rents are going to come down. But we've found that rents really aren't that elastic. So if they've gone up to a certain level, we're seeing rents still remain there and still increasing. So that's something that's really important to think about because it's not elastic, unlike interest rates and in some respect housing values themselves. If you have a look at this, you've had this uptick just recently, really over the last month or two, in relation to the annual pace of rental growth. As I said, it was coming down. The yields were pretty steady, but now we've seen this uptick, and it'll be interesting to see what happens over the next quarter or two. But it may likely remain because these interest rate cuts from the RBA feeding through means that property prices, I think, will be given a tailwind, and so perhaps more people will be looking to say, well, we're going to rent for a bit longer, and there'll be more competition in an already extremely tight rental market. So as I said, yields have remained pretty steady around that 3.7% for quite a while, and as you can see there, again, massive variation, as I said earlier, in terms of house price moves. Again here, Darwin, regional Northern Territory, which is mainly around Darwin, have been standouts in terms of growth, and Sydney has been the most subdued. But bearing in mind, the starting price in Sydney or Darwin were massively different. So I think overall, as you can see, pretty consistent between most of the major capitals, and I think it may increase. So how do we use all the research and how do we put that together so that we can actually, I hope, answer people's questions, not just by giving them statistics or data, but giving them some kind of practical outcome, I suppose, that we see developing in the medium term. The first one is, and people ask, what's happening in the Aussie property market, and most of our clients know, have spoken to us, there is no such thing. The market in Darwin or Hobart or Perth, Brisbane, Sydney and Melbourne, they're all different. And that's really important to recognise. And then if you're going to a regional centre, that's different again. So let's have a look at some of the things that are happening. And one of the important ones, of course, is listing activity. And that sort of gives you a pretty good idea of what the market's doing. And listing activity across the capitals and the rest of the state regions was markedly lower over the 3 months to August relative to last year. So that means that people are not as keen to sell their properties. And that again then puts further upward pressure on the existing stock. So people are going to potentially pay more for the properties that are listed. And it's significant if you have a look there. I mean, new listings changed from the equivalent period last year. The combined regionals down 10%, capitals down 12.2%, and across Australia down 11.5%. So that's really significant, and I think it's something again that people need to look at. And a lot of our clients are saying, "Oh, look, I'm thinking of potentially selling something." So we're saying, well, have a look, think about the spring selling season here now, sort of September, October. But then again, we question why are you selling something? If there's no pressing reason to, then perhaps they need to consider that may not be the most prudent decision to take. if we look at this post-COVID, people's preferences have changed, and we're now seeing that this has really become entrenched in terms of what people want from a dwelling. And many of our clients now still want a working space in their home or in their apartment, so a multi-purpose room. A lot of demand for that. And this here, we're getting smaller households, so smaller household formation, less people living in a household, but larger spaces. So people are saying, look, I want a bigger area for my home, whether that's a freestanding home or an apartment, and a lot of them can afford to do that. The stronger preference for suburban living has somewhat subsided, and people are now going, as I said, for where they can get the greatest access to amenity, and depending on the demographic, if they're sort of heading into retirement, security is another big one, and obviously healthcare. So this we've had at the last quarterly review, and it's important because we still get asked about it all the time. People saying, the prices have gone up, Sydney's just crazy, I mean this can't continue. Well, I never say never, but I mean I've been hearing that for probably 30 years, and it does continue. So people need to look at what's actually happening on the underlying drivers, I suppose, that cause this to happen. The last 5 years clearly have been a strong period of growth in many capital city markets, but in relation to what's going to happen over the next 5, 10, 15, 20, 25 years, I think that will continue to keep growing, and different areas obviously grow at different rates at different times, and that's why research is so important. But it's important, I think, more so if you're looking to buy into something where you want to live or need to live. From an investment viewpoint, as long as you're buying quality assets, it's a bit like buying, some of the top 20 Australian stocks. They vary in price quite a bit. However, over a longer period of time, they continue to go up and provide people with good investment outcomes. So this just came out, and I saw it in Bloomberg today. I thought I'd pop it up here because that's one of the key underlying situations. If you look back in 1990, the increase in housing stock was around 2%, and population growth was around 1.5%. And if you can see here now, currently population growth around 1.8%, and housing increase in housing stocks around 1.2%. So we've got this situation where we're suffering from an imbalance already. We're undersupplied in terms of new housing, and that's going to continue because the roadblocks to providing new housing supply are many and large. So the cost to do that is really weighing on new developments at the moment, because builders and developers can't make projects stack up from a feasibility viewpoint, and quite often they're being delayed by a lot of bureaucratic red tape. So it makes it really difficult to bring new supply on, and people are also then saying, well, it's not just that we need to live somewhere, we want to live somewhere, and that's generally in a different area where if by necessity they had to, they could. So all those things feeding through, I can see this continuing over the next 5 to 10 years, especially in some of the housing markets where we're seeing a great deal of interstate migration, and I'll come to why shortly. So this is the latest Cotality Home Value Index, and as you can see, both short and long-term value growth varies greatly. So if you have a look, on the right there, over the past 10 years, Sydney's grown 55%, Adelaide's grown 95%, Brisbane 94%, Darwin 6.5%. So massive dispersion there, and I think that's what people say, well look, we do need a bit of a hand in terms of making decisions and what to do and what to expect, because people are always worried about losing money, and it's it's almost insane, because if you look at residential property in Australia as an asset class, it's pretty hard to lose money. And people still manage to do so, but that's just because, like with anything, they're speculating. So they're often borrowing more money than they can actually afford, and they can't keep that asset as they should, etc. So, there's a lot of things that you really need to assess before you make a decision. But if you do that properly and get some assistance and help with that, getting a negative outcome is pretty hard. So, putting it all together, our clients would know about this. We say it's as easy as pie in relation to investing in residential property. If you've got your key drivers, population growth, infrastructure growth, and employment growth, and you've got that in an area where you're going to buy a quality asset as an investment that you need to rent out, you're going to go pretty well. So if we look at the various capital city markets around Australia, we'll look at a few of them here. Sydney, New South Wales. New South Wales has always had the most diversified and strongest economy in Australia. I guess affordability remains the biggest challenge, because prices have continued to move up, as I've said, and they are now far more expensive than in any other market within Australia, and that is a challenge, and we see it with our clients. And it comes in, all levels of income, I suppose, where people simply can't borrow enough money to buy the property that they would like to. And that comes down, even more importantly, if you're an owner-occupier. So if you're wanting to buy your home and you can't afford it, it's definitely an issue, and it's not going away. So there's an ongoing demand for quality, again, that costs more. Quarterly house price growth has increased, and immigration demand remains the strongest, although, as I say, we have to look at that because Sydney has the biggest inflow of net overseas migration, but most of those people rent, certainly for the first few years. So if you look at that here, over the last month, Sydney's up 0.6%, 1.8% over the quarter, which is in line with the national rise. And over the last year, it's up 1.6%. So that's not a massive number, but that varies quite a bit depending on, I guess, which quartile that property is in. Certainly in certain locations around the city, that number isn't relevant because it's much higher. So it's important to look at that. And currently, Sydney dwelling prices are at a record high, as they are in a number of markets, you'll see. Victoria also has really strong net overseas migration. Again, those people tend to want to rent for a period of time, number of years. It's still one of the most affordable rental markets in capital city markets in Australia. And finally, quarterly price growth has ticked up, or continues to tick up. But the return of overseas students was put at risk a couple of months ago with new legislation pending from the government. Now that's been deferred. So there's still a bit of uncertainty, I guess, in the Melbourne market in particular, around what will happen to the numbers of overseas students coming to Australian universities. So if you look at that there, last month up 0.4%, 1.2% over the quarter, and just 0.5% over the last 12 months. So it's been a weak capital city market, and it's 3.4% below its peak, which was set in March 22. Perth, on the other side of the continent, and a different situation there, it's had the biggest annual capital city price growth, but it's slipped behind Brisbane and Darwin now for quarterly. It's had very strong population growth, highest annual rental growth for all dwellings, and it's showing some slowing affordability as those prices take effect. So it's been a really strong market, and there's still a lot of good tailwinds there in terms of some of the drivers, population growth. If you look at that up, just under 1% over the month, 2.6% for the quarter, and up 6.5% over the year, and the dwelling values are at record highs in Perth, as in Sydney. So if we have a look at, I guess, this is the hedonic home value index put out by Capitality now. This is what's happened. It sort of gives you a bit of a roundup in terms of median value. Some of the other forecasters or research houses now put median value in Sydney at over 1.5 million. But if we look at that, Brisbane has moved up to the second most expensive capital city market. It was Melbourne for a huge number of years. That's now changed, so it's important to look at all of these things. And Canberra is also, pretty well up there. Adelaide has moved up there. So there's been a lot of changes over the last year to 18 months in terms of housing values all around Australia. Bear with me here. So this is a question that we get all the time, mainly from an investment viewpoint. Should I buy an old property or should I buy a new one? And there is no correct answer to that, to be quite honest. It really depends on, I think, with an old property, and most people look at this, they think they're going to make some kind of mega killing on buying that. Well, look, if you've had experience in the building industry, or you've got lots of time on your hands because you're about to retire, you can enhance the value of that property through renovation or redevelopment if you have the necessary skills and time. But most people who try and do this don't have the necessary skills and don't have the time. And then when they come down to it, especially now, trying to get trades to go and do that work, and then facing the battle with councils in terms of getting the necessary approvals, it's a really difficult process. And if something's a standout opportunity, some local builder or developer will generally snap that up anyway. So that's just something I think that people need to bear in mind. Certainly I think it's very worthwhile. As I say, if you've got the time, you've got the ability, and you've got the funding to do it, then great. But most of our clients are, as we said initially, very time poor. They already earn high incomes. So they really want a situation that's no touch, and we can provide one that's low touch in terms of being contacted for property management issues, repairs and maintenance. And new dwellings clearly are easier to rent out. You get better tenants, and they tend to stay there for a long time and not cause you any grief. So most of our clients prefer that, but either situation works depending on what your personal situation is. One of the things, not just with property but with any investment and just living in Australia, is our tax system, which is onerous and burdensome. So trying to remove some of that is really a great experience, and we're lucky because we have these things called depreciation allowances, Division 40 and Division 43. So you can deduct basically 2.5% of the price of building something if it's new over the next 40 years. And you can deduct other things for fixtures and fittings, etc., improvements over their shelf life, which a quantity surveyor will do a report and give you, and you can give that to your tax agent so you can claim it with the tax office. So those sort of things where you don't actually spend any money but claim if you get the right assets, some really pretty large deductions against your personal exertion income are really handy. And our clients, being high income earners, do like that. So putting all that together and the data that we've been accumulating over the years, we've sort of looked at this region, being southeast Queensland, for a number of years now, and it continues to perform the way we expect it to. It still has a substantial value gap when compared to Sydney, even though it's moved up to number 2 in Australia. It's still got the strongest migration from interstate the last 15-20 years, and that actually is continuing, because I look at the MB.BS population numbers every quarter, and as you'll see in a minute, that's continuing. And there's been also a lot of talk in the media in Australia lately about the work from home lifestyle factors. So, the Victorian government tried to enshrine that into legislation, giving employees the ability to work from home, which has been met with mixed response, I think, understandably. But it has a very well diversified economy, and I think it still represents probably one of the best bang for your buck regions to contemplate if you're looking to invest in residential property. So if you look at what's happened in the last quarter was up 2.3, last month 0.7, 7.3% over the year, and like a couple of the other capital city markets, it's currently at a record high. So if you look at this now, and this is really important, latest numbers, you still have Western Australia, Victoria and Queensland as the three standout states in terms of population growth. WA at 2.4%, Queensland and Victoria at 1.9%. They're very strong rates of population growth. And Queensland's certainly been the largest net beneficiary of internal migration, so interstate migration, since before COVID. If you have a look at that, interstate arrivals into Queensland, 106,000, net interstate migration, nearly 26,000. New South Wales, minus 28,000. It's by far and away the largest nominal rate of increase there. Overseas arrivals, as usual, the strongest ones have been particularly Sydney and Melbourne in those two states, and you can see those are pretty large numbers. Then falls away, Queensland being of any real significance after that, but then you can see it does fall away with the other states. So if you look at that, I think this, in a sort of graphical sense, really shows you what's happening. And these are the latest numbers from December. So you can see, this outflow, it's mainly Sydney, and it's mainly going to Queensland, to be honest, and WA. So, they're the two markets that I think, have those tailwinds in place, and I think it will continue. Queensland's been like that for 5 years, and WA has picked up more recently, but both going very well there. So if we look at that, Brisbane's population is projected to be 3.2 million in 2033. Populations of Brisbane is actually projected to overtake the rest of Queensland by 27. It's just around the corner. It'll be the first time since 1978 that Greater Brisbane has had a larger population than the rest of Queensland. So, let's look at that, and then we'll also look at some of the other longer term tailwinds that are in place there that I think are really worth thinking about. In terms of supply and demand, if we look at what's happening there at the moment, if you're looking for an apartment within 5 kilometres of the CBD, so in other words, something that does have access to all of the amenities that most people want if they can afford to have those, is suffering from an incredible undersupply of new dwellings. And since apartment buildings don't get built in 9 or 12 months, that's really going to continue for quite a long time. And we're seeing that in relation to new supply that's coming to the market. It just gets taken off the market within an incredibly short period of time. So I see that happening for quite a number of years to come, because being able to catch up to this is no mean feat, especially given where the cost of construction is these days, and access to the trades required, because both federal and state governments are embarking on some pretty large and significant infrastructure projects that are occupying those trades. One of the major tailwinds, I think, that is really important for southeast Queensland, so Brisbane, Gold Coast and Sunshine Coast, the 2032 Olympics. They're obviously going to provide a massive increase in terms of employment, but that employment may be short term, but a lot of it will be long term. The infrastructure that's being supplied and delivered is outstanding, so that's going to provide a lot more, I suppose, benefits in the longer term and productivity benefits, because a lot of those are transport related, and in terms of education, other amenities that are being provided in healthcare are really important for that southeast Queensland triangle. And I look back and I think about the Sydney Olympics. It was hosted in 2000 by Sydney, pardon me. And then you look at what happened in the 10 years after that, where the combined capital city markets went up about 34%, but Sydney went up over 60%. And I look at Brisbane. When I travel overseas now, I speak to people and I talk about Sydney, and just about everyone knows where Sydney is. But depending on where I'm travelling, I talk to people about Brisbane, and a lot of people still say, where is that? So, when you look at the Olympics, they're only here for 2 weeks in 2032, but when you've got several billion people watching that on their screens for 2 weeks, I think most people will then know where Brisbane is and see what it can offer. So I can see, the decade after the Olympics also being a pretty good time if you're looking at that region from an investment viewpoint. So not just the period up to the Olympics, but I think the period after that is a really positive one. If you look at some of that infrastructure, some of it's already been completed, some of it's about to be completed, and some of it's ongoing. They're really making the city a very efficient, livable space. And I think that's really creating this ongoing drive for people to keep moving there from other states. And that's something that I say is a really important statistic to look at, because those people have already done their due diligence. They've usually thought about where they're going to put their kids into school, or the jobs that they're going to be in when they go there. So they're far more likely to buy something almost immediately, or certainly in the short term, as opposed to international migrants who are going to rent. So let me just put this on.
This Games was never going to be like other games. It'll be a Queensland Games. We can't just build for a few weeks of competition. We've got to build for the decades to come. We need a plan, and it's time to deliver.
The only thing bigger than the Olympic and Paralympic Games is the opportunity to connect Queensland by building the roads and infrastructure we're going to need for decades to come, all while we drive tourism and back our grassroots clubs. And now the new Queensland government has set the plan to deliver it. To keep our growing population moving now and beyond 2032, Queensland needs a better connected and accessible transport network. For Brisbane,
and see some of these things that are pretty exciting that are being developed, particularly in Brisbane, Gold Coast, Sunshine Coast, in terms of some of the new Olympic villages, the arenas, and then the ability to transform some of those into new living spaces for some of the residents in those areas. I really do recommend you have a look at that. I think it's pretty important, it's pretty good, and it gives people a really good pictorial video understanding of what's actually happening. So just moving on to the rest of it, I mean, what's the value proposition, what we think about? It's really helping people not make some of the common mistakes that property investors tend to do. So we like to help people buy into a strong market of the future, and that's just what I'm talking about. What's going to make that market remain strong, not just now, but 5, 10, 15, 20 years into the future. Because a lot of people buy into things when they're really a raging success, but quite often that doesn't then translate into a long-term sustainable growth pattern. Ignoring your point of difference, so you see people buying investments, quite often when they're new investments, they might be houses and what developers call growth corridors, but they're really all the same, and they're usually a long way from CBD and other amenities, and there's thousands of them just the same. Same goes for apartments in blocks of 1,000 apartments, whether that be in Surfers Paradise or Docklands or wherever. Waiting too long to invest, and this is an interesting one. As I said, people always worry about losing money, and I think that's what makes them wait, because I've asked clients this before. They said, oh, I've really been researching the market for the last 3 years. And so, well, what did you find out? And they go, well, I should have bought something then. So I think it's that fear of loss, which in most instances is not justifiable at all, that makes people wait for no reason. There's no lack of information or research out there. It's just a matter of having the time to look at it all and then trying to make sense of it, because a lot of it's contradictory. And then if you go through all of that and you come up to the realization that I should have done something years ago and I haven't, that any investment will do. Because as I said, research is really important, and you've got to buy quality assets in locations that should perform sustainably over the medium and long term. Here's what I'm saying, Port Hedland is a good example of a one economy sort of town. It's based on iron ore. Docklands, or as I said, Surfers Paradise, doesn't really matter. They have buildings with 1,000 apartments in it that were built in the heyday when everyone was selling things to Asian investors, and they're not really the sort of dwellings that you find most of the Australian population aspire to or want. So they want larger, oversized apartments if they're going to have those, and they're really looking for dwellings that suit owner-occupiers. So I think that's really important. We try and tie it all together for you. Look at that infrastructure growth, that employment growth, future sustainability, strong economic activity now and projected into the future, and the unique attributes of the asset you're going to buy. So, if you're buying a house or an apartment on Sydney Harbour in the eastern suburbs, they're not going to make any more of that type of land. If you're buying that as an investment, it's probably tying up a lot of capital, but in terms of unique attributes, they'll remain. If you're buying something on the beach on the Gold Coast, again, there's only so much beachside land available. It's very little actually when you go and look at something like that. So it doesn't matter where it is, you've got to look for some of these unique attributes that will then give you the unique ability to have some price control if you ever want to sell that asset in the future. And it certainly helps with getting a great tenant and being able to rent that out for more than the average market in that area. So what are some of the opportunities for this year and past this year? We look at some of the coastal markets certainly have benefited from, I guess, the work from home situation, where we find a lot of executives from say Sydney or Melbourne have been buying second homes in say the Gold Coast or Sunshine Coast regions in particular. Also somewhere, if you're living in Melbourne, some of the beach areas there. But they're being able to perhaps work from home for 2 days a week, so they can have 4 days in a beautiful coastal location and spend 3 days in their offices, whether that be in Sydney, Melbourne or Brisbane or wherever. And that's really, I think, here to stay. So clearly if you're a surgeon or a medico that's reliant on performing in a theatre or a dentist, etc., that's not going to work for you. But a lot of people who are in IT or marketing, many other fields, they can actually do that very readily, and that's something that we're seeing a great deal of demand for. These people have the capability from a financial viewpoint to do that, and they want luxury. They want oversized dwellings. They want all the convenience and mod cons that some of these buildings now are able to deliver. It's like going to a 6-star resort, and you can't get that, unfortunately, if you're living in perhaps a large established house where it's just not viable to convert it into something like that. So I'm here in Brisbane, Queensland. We're in the suburb of Windsor, and behind me is a new site that's being built named Sayre. This is approximately 4 kilometres from the CBD, in close proximity to Royal Brisbane Hospital, and you have a lot of amenity around this area in terms of transport, in terms of restaurants, bars, places you can go to in Fortitude Valley, which are clearly not far removed. And it's interesting to note that the skyline here reflects some of the urban development that's happening in the sort of inner middle ring of the Brisbane region. We always like to have a look at construction before and during and after when sites are getting built to give us a far better understanding of what our clients are going to see when they receive their finished product. What I'm showing then, again, please have a look at this online, but in relation to what we do, we try and look at sites long before they become developed. We look at them during that period and then after, to make sure that everything is produced exactly as it's shown from the first instance. And we've been doing that for decades, so it's really important, I think, to have that sort of quality control process in place. And that way you can be very confident if somebody purchases a new dwelling that's being erected, that they're going to actually receive what they think they're going to get. And having done it for so long, it's important to also then have the confidence to know that the builders you're dealing with are there to stay and produce quality product on an ongoing basis. Because there really is a lot of, there are a lot of issues in the construction industry, as most people will know. Doesn't matter where you are in Australia, that is an issue. So it's really important to, again, do that research and make sure you're dealing with the right people. Now that's something that, everyone's interested in is, who pays for things. So we actually look at that, and in most instances, if you're an Australian tax resident, someone living in Australia, generally if you buy the right asset, it sort of looks a little bit like this. Who pays for the property in the first year? You pay around 6%, the tenant 73%, and the ATO contribution is 21%. It's interesting now that we've had 3 interest rate decreases, that actually for people paying the top tax rate, you can actually acquire a property that doesn't cost you anything on an after-tax basis. So if you look here, if you're an Australian expat, your cash flow may be $400 a week going out, but if you're an Australian tax resident to buy the same property, it's actually not costing you anything, but is positive in terms of cash flow by $67. So the interesting thing there is, of course, that the non-resident doesn't miss out on those benefits. It's just that they're deferred. If you're an Australian, then you're offsetting those depreciation items that I spoke about earlier against your other personal exertion income or investment income. Whereas if you're an expat and you don't have enough other Australian taxable income, then you'll get to use those tax credits when you sell a property, or if you move back to Australia, you can then use all those tax credits to offset against potential sale of the property or just your personal exertion income when you get back. And many of our clients over the years have had a really soft landing back into Australia, and a fantastic outcome for them from a cash flow viewpoint, where they've been able to use those tax credits and in some instances not pay any tax for a couple of years. So this is what happens, and I guess that who pays for things over 10 years. If you look at the expat, you've paid for 23% of that asset. If you're an Australian tax resident, you've paid none. But again, this is really a timing issue. So ultimately it ends up on this basis where if you buy the right assets, it can actually be a terrific investment because it doesn't cost you anything from a cash flow viewpoint. So we produce those reports that I said, those property investment analysis reports, and that refers obviously to people's own particular circumstances, and that varies greatly depending on the asset that they're looking at and their personal income tax situation. So really important to do that as a bit of added research, I think, so you can make some well-informed choices on what to do. Now, this is a slide that I've had for quite some time because it's really important. I think property is a great growth investment, but it's not something you should speculate on, and that's where people, I think, get into trouble. They tend to get into trouble if they're speculating on just about anything. So, property, the longer you keep it, generally speaking, if you've done that research up front or had someone do it for you, and you have all those other tailwinds and attributes working in your favour, the longer you keep it, the better your return is going to be over time. What we find, or what the stats show, is that most people tend to hold property sort of 2 to 4 years, or that bump there. From 4 to 8 years is the majority of transactions, and quite often people sell those. And I sort of ask myself why, and I ask them generally too, like, why did you sell that? Now, quite often it may be, a divorce, it could be a health situation, so really understandable. But sometimes people just say, oh, I've made a profit and I want to sell it. And you think to yourself, well, what are you going to do with the money then? So if you have no better purpose for that money, I think it's usually far more advantageous to keep it, as you can see. If you want to keep something 25 years plus, you're really going to get a pretty significant bang for your buck. And just ask anyone, perhaps someone's parents or grandparents or friends, where they bought a house 30 or 40 years ago in a capital city market in Australia, and they're selling it now. It's generally speaking a very, very advantageous financial outcome, not to mention that they're also probably not paying any tax on that gain whatsoever because it's been their main residence over those years. So really important to bear a lot of these things in mind and spend the time up front rather than saying later on, I wish I had. We like to think we helped many people with solutions. We've been doing this for over 3 decades. As I said before, through our lending business via Wise Guru, we use Aussie Loan Guru, and for our clients we can supply even foreign income clients, Australian expats, with up to 85% loan to value ratio loans for the same amount as if you're an Australian resident surgeon. You're not paying LMI or lender's mortgage insurance to the bank, and it enables you to either develop your property portfolio more quickly and efficiently, or simply get into the market or add to something in terms of a place to live in. So we can, I think, provide solutions in many areas. It depends on what people need and what they want. But if any of the items within the presentation have caused you to think about your own situation, don't hesitate to contact us, reach out. We'll try and assist you with your own personal situation. We can make that as targeted or as broad as you like. But we help people, generally speaking, not just with a transaction, but it's more also the continued and ongoing support and service and panel advice that we have built up over the decades, and the opportunities that we can generally find for people in a market where those opportunities are really genuinely hard to find. Please contact us, as I say, email us or call us, and we'll have somebody reach out to you, and you will be sent a questionnaire to help us try and improve our performance over upcoming reviews. So please fill that in and send it back to us. And apologies for the technical glitch, but when you look at the presentation on our YouTube channel, that will all be corrected, and hopefully you'll get some more interesting information out of that. I look forward to seeing you at the next quarterly review. I wish you all the very best in terms of your own personal investments. Gary, thanks very much for that. I hope to see you next time, and perhaps see you in Hong Kong before that. If anyone has anything else, any questions now, please, please let me know. I'm here to answer them if you wish. All right, well, I think we will wrap that up. You happy with that?
Andrew.
My pleasure. All the very best.
Cheers.